Okay, ladies and gentlemen, we are all set up and ready for our panel discussion. This will put the spotlight on how investors spot brands with a winning potential. How investors spot brands with a winning potential. It's my privilege and pleasure to invite on stage our distinguished panelists. He is Senior Vice President, Investments, Sharrp Ventures. Please welcome on stage Anand Shankar. Come on, ladies and gentlemen, can we have a round of applause for Mr. Anand Shankar as he takes the stage? He is Managing Director, Everstone Group. A warm welcome to Prashant Desai. Mr. Prashant Desai. He'll be joining us. He is Chief Executive Officer, Ask Hedge Solutions. A warm welcome to Vaibhav Sanghavi. And ladies and gentlemen, on stage already is our distinguished moderator, Mr. Bijou Kurien, Chairman, Retailers Association of India. And it's over to Mr. Bijou Kurien and the panel. This is our final panel discussion of the day. No, we've got one more, yes. We've got one more, yes. We've got a lot in store, so I'm sure that we're going to enjoy every moment of the next two panel discussions. Over to you, sir. Six.
Check. Thank you. Good afternoon, good evening, depending on how you consider this point of time in the day. I know that it's the last bit of the second day of a long two-day RLS, so a lot of people might be fatigued. But this is about providing vitamin M. And when I say vitamin M, this is about what runs all our businesses. So we have the option of running a business on our own money, or we can actually borrow money from the bank, or we can actually get money from outside investors. And this session is largely about what it means to get money from outside investors. So you have to understand it in the framework of who are these outside investors, one. Secondly, what are they interested in investing in? Thirdly, what do they look for when they actually invest? And since they're not founders of the company, obviously they look for a certain return and they've got a certain time horizon. So by which time will they want to exit? And what kind of returns do they expect? That's one part of it in terms of actually infusing money into your business. And the second part of it is that having put money into the business, obviously they want to also be involved in the way you're using the money, and they want to be comfortable that that money that you have been invested in or they have invested in your business, that money is used wisely in order to be able to create the right returns. So we'll just keep it simple within this larger framework so that we don't confuse various other things. We're still missing Prashant, no? Sorry. Oh, he was here just now. He was sitting here. I thought he went round the corner. Okay. So Anand, we'll start with you then. When you come up ahead. In terms of your part of Sharrp Ventures, which is effectively a family office investing in promising startups. So what would you do? Which kind of sectors do you look for when you invest? In which kind of sectors do you stay away from when you invest?
Oh, thanks. Happy to be here. So in general, see, any venture investor has a certain mandate because most funds typically end up raising money from other people called limited partners. So at the time a fund is being raised, they generally indicate what will be like, preferential sectors, where they need to allocate capital with a certain desired, target, return, as well over what period of time. Sharrp is a little bit unique, sir, in that aspect because this is all prop capital of one, large FMCG, family in India. So given the background of the promoters, we typically invest in consumer brands across stages because we understand that well and we believe we can add value, also to some of those portfolio companies.
So would you invest in an FMCG company in which, whose products compete with Marico?
Not necessarily. Some of these companies have scaled and, eventually, become, challenger brands for, the larger group. But as I told you, this is all prop capital, so we typically look at only a financial lens. So there is no strategic, intent, when we try and, cut deals.
Okay. So Vaibhav, a question to you, which is about when you look at investing, what are some of the criteria that you look for when you look at actually what would be a desirable investment that you would make?
Sure, thanks. First of all, thank you very much, and it's great to be in between the entrepreneurs, actually. So when we talk about investments, and especially on the retails or of FMCG or brands, I can give you more of a perspective from how we look from a public market standpoint. Probably that kind of would lay the basis of how the subsequent kind of investments happen either on the private space or at a much early stage as well. When we look at, you look at the opportunity first, let us accept the fact that India, and the demography, is one of the best and envious to a lot of countries across the globe to have a market like this where they can, have the potential to offer good products and achieve that scale as well. Now, how do they achieve? I think there's a lot of debate about it, but on an overall basis, the first thing is we look at the global or a global opportunity in that sense, and that once you identify the TAM, which is your total addressable market size, is when then you drill down in terms of a particular company, the product size, the advantage on that product or the moat of that product, and subsequently it then eventually comes to governance, which is an extremely important element which we look at before investing, and the multiples, of course. So all in all, when you scan across all these parameters is when you probably come out with an attractive investment options where you probably would want to invest for a longer period of time.
What role do the founders play? Capability, background, and all of that?
No, of course, founders play an extremely important role. Purely one, skin in the game, right? I think for us as an investor, skin in the game is extremely important. Second, in terms of the pedigree of the founder, the methodology or the governance structure they have kind of incorporated into the company, I think those are very critical aspects. Lastly, we try to see that also an element of adaptation of technology, or how open, the management is towards new technology is something also we kind of closely kind of have a look at as well. So yes, of course, founders do play an important role. Their entrepreneurship, their dynamism, all, kind of overpowered or probably, having an umbrella of great governance. And that is what we will see.
Great. Anand, just picking up point from what Vaibhav mentioned, which is about governance. He mentioned this point about governance. How do you ensure that in the companies that you have invested in, that their governance levels are to your satisfaction?
So good question. See, I think quite honestly, it's an evolution for most of the companies that we invest in, right? So when you sort of look at a very early stage startup, I think survival is what matters most, for them. So founders are scrappy at the end of the day. They try and get their product right. They try and get the, GTM right and the price points right. So it is more about sort of surviving and actually hitting a certain value proposition in the mind of the consumer. I think as companies scale, they also realize that they have a certain, trusteeship, value when it comes to, investor money that, they take. So typically over a period of time, they try and have more rigorous processes in place and also try and have, maybe better, more rigorous accounting and, aspects, such as those, which can both give investors comfort and also enable the company to deliver more strongly, right? Because you need a very strong foundation if you have to sort of scale. So from a startup lens, I would definitely say that it is a priority from day one, at least from a founder mindset perspective. That is what we test for. But obviously the systems percolate down over a period of time as they sort of scale.
Okay. When you look for investing, obviously you have an opportunity to invest at different stages in the company's growth. And generally, at a very early stage, you normally have angels and seed funds. Then at a slightly later stage, you might have a VC fund. And then at a much later stage, you have private equity. Obviously, you all are looking largely at investing at the VC space. When you look at investing in the VC space, between risk and return, there is obviously some correlation. Higher the risk is higher the return that you expect. And higher the risk means higher the mortality. So when you really think about investing at your stage, what kind of risk return rewards ratios do you look at?
See, I think there is no scientific answer to that, quite honestly. I think the market is very cyclical. Of course, given that there are certain inherent, risks associated with this asset class, which is illiquid investing in India. So obviously, you'll have a country risk element and then the asset class, risk as well. So the desire for most funds will be north of 20% or 25% rather. And we also are LPs in a number of funds. So typically, we would like to segment between a VC and a PE also, right? Because PE will be, slightly more mature companies which perhaps have a free cash flow. So we might be happier with a 20% return at a PE level. But at a VC level, ideally, you need to push, north of 25 or, 30, rather. I think that said, it is more a plan on paper, to be very honest, because no one can forecast very exactly, where these companies will end up being after a 10-year life cycle. So obviously, investors have to be patient to sort of see through and hold on to their winners long enough so that actually returns can materialize over a period of time.
Great, thank you. Vaibhav, if I were to ask you the same question.
So again, just continuing from what he said is, no set kind of checklist in that sense. But what we try to assess is, as you mentioned, the drive of an entrepreneur. Second, the product in terms of what is it kind of addressing, whether it is kind of, replacing your existing stream of products or probably creating altogether a new product stream. Now, the difference between that is, something like if I take an example of Apple, when they came out with iPod, right? I mean, it created a totally different new market altogether. So if that is the case and if that is the kind of innovation which is there, of course, I think it's just to be taken up, with both the hands in that sense. But rarely do you find that kind of innovation and probably have. So that is where you try and find out that a good quality product, which is which is just a complementary or a substitute or probably adding some more value to a customer is something which we'll definitely look for, before investing in that sense. So all in all, great management, dedicated management, skin in the game, plus the quality of the product, which it's not only one product, but for a diversified business model, you need to keep on innovating and kind of keep on doing lot more. So all of these things probably would come into picture because ultimately these all things will probably lead to better return on equity and profits for the organization, and ultimately to the investor as well.
Sure, thank you. So I think the bottom line here is that each one of you all who are looking for an outside investor should be clear that there is a certain expectation in terms of return when the outside investor, especially a formal institutional investor, were to invest in your business. That return can be anywhere from 20 to 30%, depending at which stage they would typically, invest in. The second part of it is that return is very closely linked to your business plans in terms of your potential for growth, the market that you're operating in, the level of competition in that particular market, the uniqueness of whatever product or service that you're offering. So all that also then defines a certain level of growth that you can expect. And unless you're clear that your business model of the current plus whatever you want to add in the future, and that, if you were to extrapolate into the next 3 to 5 years, can actually help to deliver that kind of a return that the investor is looking for, you will certainly find that there will be misalignment in what you think is acceptable versus what the investor is estimating is acceptable. So one of the biggest challenges that we all see in this space is that at the end of the day, there is misalignment between investor and investee. Sometimes the investor thinks you should be growing faster. Investee feels that maybe I can't do it that much. There are complaints sometimes that investors are forcing us to be able to get revenues, pushing us in terms of making sure that the business expands rapidly beyond our capabilities. And all of that finally translates into tension between the two parties, investor and investee. And many a time the destruction happens when that tension begins. Some tension is healthy because I think it also puts pressure. It cannot be an absolutely tensionless kind of a relationship. But on the other hand, too much tension also can translate into some problems. Sorry.
No, I absolutely agree with you, Bijou. In this sense, one of the things what we have seen also many a times is the difference of view and a vision between the promoter and the investor in that sense. See, we have to understand that the entrepreneur is there for an extremely long period of time, whereas the investor, whether it's a VC fund or a private equity fund, has a limited tenure in terms of that investment, and they need those kind of exits. So when both of those kind of differ, then there is always going to be some amount of views which are going to be different. Now, how you solve it, how you kind of, in a proper governance structure, how you are able to manage it, is the trick of the trade in that sense. Lastly, I think it is always good, before you probably dilute or probably sell it out, to convey the vision and your certain conditions, probably, where if that is acceptable, please come, or else thank you very much. So that has to be extremely clear.
Good. Thanks, Vaibhav. Another question, which is about active versus passive investors. Some investors not just invest in a company, but they also make sure that they get actively involved in the operations of the company and help it to be able to grow and things like that. Whereas in some of the cases, the investing approach is very different, because of which what happens is that they prefer to remain only financial investors and not actively involved in the operations of the company. So Anand, if you were to look at it, what do you see as the merits and demerits of both of these?
See, I think it is very subjective to every investment that founders are open to at the end of the day, right? Because just taking from my co-panelist point, see, I think investors have a very limited shelf life, in the life cycle, of a company. So ultimately, if there is a marrying, in terms of vision and the pace at which they want to sort of get there, obviously there has to be a value add element that the investor will have to sort of roll up their sleeves and help, right? Because the onus can't be only on the founder to sort of deliver. But I also think that, see, there have been some success stories where people have been passive as well, where they don't interfere and add value. So I think that can also work in certain cases. See, obviously, I think at the outset, we need to think that the founder knows the business best, right? Because they're living and breathing it every day. So as I told you, investors have a very limited shelf life. They may bring in certain perspectives at various points in time and may be relevant, but obviously it is the founder show very clearly. So I would think it's a subjective situation. So there is no pro or con per se, but it just ends up being what it is on a very case-by-case basis.
Okay. Just one question on a sector, which is quick commerce. There's been a lot of conversation about quick commerce over the course of the last 2 days, both as a threat and as an opportunity. And depending on which side of the fence you are, sometimes you see it as an opportunity or as a threat. From an investor's perspective, what is your view? And I'll come to you also, Vaibhav, on this. What is your view on investing in quick commerce?
See, I think when we invest in brands, we typically have a very long-term outlook, from an investment exit standpoint, right? So when you sort of extrapolate 8, 10 years down the line, ideally a brand will also have to sort of have touch points across multiple channels. So today, QCom is sort of becoming a channel of prime importance for many brands, at various points, in their life cycle. We have seen some early stage companies sort of go to QCom because in certain cases it provides an easy revenue, runway. And certain companies sort of differ that, because of, channel commissions and various other aspects, and also for the need to have certain diversity and not become excessively dependent on Q-commerce, channels. So definitely as a channel, we would like to see some representation of brands, having a play in Q-commerce, because that is becoming a very meaningful portion. So in fact, even the very large FMCG companies like Marico and HUL derive as much as 15 to 20%, revenue coming from digital sources, of which Q-com is a very big piece today. I think it's also where the customer is moving to today. So the customer prefers a certain channel to shop. Obviously, as a brand owner, you will need to sort of be available on the channel to sort of, be accessible for a customer. So definitely, I would think it is a must-have, play. But the founders will also have to be prudent about, what is the cost of the channel economics, and at what scale you, have representation on other channels, especially offline, given that, India is still very largely an offline-driven market even today.
Vaibhav, your thoughts on quick commerce?
From public, we being public market investors, right? Honestly, that's an opportunity we cannot miss. Okay? Let's understand this, extremely clearly that where actually, and a simple example, where Zomato as a company started from and where it is now, right? Where the initial skepticism of, who's going to order food, right, at home, pay a service charge and so on and so forth. Now it's inculcated into the behavior of people. What we need to understand is that this quick commerce companies are going to be there and probably will prosper at a very brisk pace. Important thing would be for an entrepreneur to understand, your strengths and the weaknesses of what you could do as a business model vis-a-vis the quick commerce. Probably if you are flexible enough as an entrepreneur, take the advantage of a platform to accelerate your own business in that sense, right? So the ability of an entrepreneur to be extremely flexible, adapt to the newer changing variables is extremely important, and in that, I think quick commerce can play a fantastic role from a business development perspective as well. So whether that's a threat or how you can use that as an advantage, has to be, thoroughly investigated or analyzed and probably taken an action in terms of the course. How do I want to conduct the business as well?
Great. Thanks, Vaibhav. I don't want to let the audience miss the opportunity of asking them questions. So if there are any questions in the audience, Amit, can you get a mic across there to him? And just ask the question and just whoever it is specifically to.
Hi, my question is to Vaibhav. You spoke about skin in the game. Now, skin in the game is also dependent on any founder having how much really the investment and the stake in the company. How do you balance this? Because you are in equity, capital market. You see Zomato, the founder of Zomato has limited share today. So how do you see this happening at a longer run?
Let me give you an example. I think, broadly, entrepreneurs would want to kind of have a more than 50% kind of equity generally, but then there is a limitation of how quickly you can expand as well. So the question the promoter has to ask or an entrepreneur has to ask is whether I want to be a 51% of a 500 crore turnover business, or I am good with a 10% of 5,000 crore business, right? And that will always be evaluated by the promoter himself. Till the time he has that substantial stake, and I would say substantial in terms of an absolute monetary sense, not on a percentage equity basis. I think the interest would be aligned with the investor in that sense. So, I would definitely look for that before investing in that.
Any other questions? Just to add on to what Vaibhav mentioned, I think Amit, also the point is that everybody wants to grow and you need investment to grow. Investment can come in the form of equity or debt. Debt can be against fixed assets or receivables. So if you are a promoter who's averse to actually reducing your stake,